So I'm going to talk today about, the title is a little grandiose, topics for today's banking research. Really what it is it's Phil's favorite topics for today's banking researchers. I'm going to tell you about things that I think are interesting. I'll probably ignore topics that you might think are interesting. So at the end, if you want to do Q&A and talk about other things, we should do that. I'll try to leave time for that. What I did with my slides is I sort of broke them into two sections. I'm going to spend a little bit of time just reviewing what I think of as sort of the classic research questions in the banking area and sort of what we think we know from the work that's been done, that all of the large amount of work that's been done in the past 30 years or so. And then in the latter part of the talk, which will be about 2/3 probably, talking about what I think are sort of the new emerging issues. Some of these things I'm going to argue are potentially really fundamentally changing the nature of banking, or we're maybe at a turning point where the banking system may change in fundamental ways. So in order to sort of talk about that as a theme, I sort of feel like I have to first sort of lay the groundwork, sort of what we think we know looking back, and then where things might go looking ahead. So the first few slides, I name these sort of classic issues or classic questions in banking, if you will. And the first one, this was posed by Eugene Fama, believe it or not, in the early 80s. Some of you probably know this paper, where he posed the question, what's special about banks? And if you're sort of just like a casual empiricist and you just look at the world, you know something must be special about banks. If you look historically, banks are sort of there, going back hundreds of years. If you look across the world, every financial system is dominated by banks or was dominated, and the banks maybe are losing to markets but are still very important. So there must be something about them that's special, otherwise they wouldn't have legs like that. What do we mean when we talk about banks? Well, basically we're talking about a financial institution that's sort of providing two kinds of sources of value, if you will. One is producing liquidity or managing the payment system that's kind of associated with the deposit side of the balance sheet. And then the other role is providing credit. And so the way to think about answering this question is to sort of ask, what is the glue that holds those two functions together in the same kind of financial institution? And the literature has sort of identified two not mutually exclusive sources of synergy that connect those two things. One is sort of based on information production. And so there are the ideas, it goes something like, because the bank runs the payment system, they have access to information, better information or more timely information about borrower health, about local economic conditions, about all the kinds of things that you need to know in order to make a loan and have that loan pay off, as opposed to some other institution that doesn't have access to that information via payments and raising deposits. So that kind of information synergy holds together the deposit piece of the banking system with the credit piece. A separate kind of synergy focuses on liquidity and the idea that liquidity is valuable. This is basically the core idea in Diamond and Dybvig's seminal paper, where basically they observe that if you, as an individual investor, want to invest in an illiquid project, you have to tie your money up for a long time because it's very inefficient to shut a project down, many projects down early. So if we have an intermediary that pools lots of people's funds, and as long as the demands for liquidity are most of the time idiosyncratic, then that financial institution can invest most of the funds in a long-term project, hold a little bit of cash in reserve to satisfy the idiosyncratic demands for liquidity, and that's a pretty stable and efficient arrangement. So those are two like really important explanations for why this kind of structure exists and is so pervasive in the world. Now, of course, Diamond and Dybvig's theory, one of the things that comes right out of it is that there's a vulnerability to a bank run. So, financial stability, and then because of the possibility of collapses of the banking system, that creates pressure for bailouts. So just to needle Jeff a little bit here, I will. Jeff's view of the bailout problem is always the government should stop bailing them out, and then everything would be fine. And I try to explain to Jeff that politicians make these decisions, and politicians have usually pretty short horizons, and you can reliably predict that they will always intervene and bail out banks in a pinch. So the classic answer to the first question of what makes banks unstable is the liquidity role, and that shows up in the deposit franchise and the possibility of a bank run. And then because governments have a hard time committing not to bail out banks, you get, the associated incentive problems and moral hazard problems, which lead to, more leverage in the banking system than you would otherwise have, leads to more risk taking than you would otherwise have. It also probably leads to a structure in banking more dominated by the largest banks than you would otherwise have, because expectations of bailouts are rationally assumed to be stronger the larger and the more interconnected the bank is. So, and again, in terms of what we know about these topics, lots and lots of research on it. I think it's pretty convincing that these kinds of bailouts happen. I mean, we could just talk about 2008. We could talk about 2020. We could talk about 2023. It's hard to imagine scenarios where bailouts don't come. And then, the apparatus of bailouts and the expectations of bailouts, changing incentives of banks, the empirical evidence for that is pretty strong. I would say, though, that the cost to the economy of this moral hazard problem is not so much about the structure of the banking system. It's, does the fact that banks are taking too much risk change the allocation of capital in the economy or not? That question is much, much harder to answer. And I would argue we don't really have a great answer to that question. That's the big question. So some people would argue, I think, I be careful what I say, but I think Summers has said things like, yeah, every now and then you need to bail them out, and you do it, and then you go ahead and continue business as usual, and it's not that big of a deal. So whether or not it's a big deal that we do bailouts really depends on, does it distort investment choices in the economy or not? And like I said, I think that's a really tough kind of thing to identify in the data. So I don't think we really know very much about that question. Okay, so given, fragility of banks because of the run risk, given the moral hazard problem, that creates a need to regulate banks to sort of rein in the moral hazard problem. And, the place where the regulation focuses most of its attention is trying to calibrate the amount of capital that banks should hold. So some very extreme view, people, typically associated with libertarian view, argue, I think Milton Friedman said this, I think John Cochran says stuff like this, is that we should have narrow banks, which basically outlaws having the synergy, the connection between the credit roll and the deposit roll in the same institution. So you get the benefit of not having the instability, but you may be throwing away an awful lot of value if you did that. And it doesn't seem to really get anywhere in terms of political support. Narrow banking hasn't really gone anywhere. So in terms of the research, people think about how should we calibrate capital, how should we measure risk of banks, and we want to have banks with more risk hold more capital. The changes to the capital rules post global financial crisis became, much more complicated and much more sophisticated with things like stress testing and linking that to the capitalization of banks. One of the issues that is on the table again is an old issue, is whether or not regulations should focus on market values of bank holdings or book values. So if we go back to the 1980s, so I'm remembering my former colleague Ed Kane, he was a strong advocate for market value accounting And what was motivating him was in the 1980s, we had savings institutions that had huge losses on their, and the regulatory capital was not capturing that. And it was a mechanism to create what Ed called zombie financial institutions. So zombies are bad. If you've seen the movie from 1968, the reason they're bad is they eat the brains of the living, right? So in Ed's worldview, the zombie financial institutions eat the brains of the healthy ones because since they're zombies, they're the walking dead, their incentives are all screwed up. They have no incentive to worry very much about the future. They tend to misprice things. And that hurts the healthier, well-capitalized institutions. Ed said, if you use market value test, it's much harder for regulators to sweep the problem under the rug and pretend it's not there. In 2008, in the global financial crisis, people were arguing it in the other direction because market valuations were so volatile during, especially particularly the period after Lehman went bankrupt. When you're in a fire sale, it's not necessarily optimal to mark everything to market and then be forced to shut your banking system down because everyone looks insolvent. So people were sort of saying, no, we need to constrain market valuation. But now, in the recent interest rate spike, Ed's view of the world, I think, is back in play because we have big uncaptured losses in bank bond portfolios. It's not flowing through to capital. So the capital ratios we're looking at now are very misleading. Another dimension that is interesting and has been a big change post-global financial crisis is the way large and small banks are treated in the regulatory regime. So pre-2008, it was basically ignored. The capital rules are kind of the same for all banks. Post-global financial crisis, the regulatory burden imposed on larger banks is much, much, much higher than it is on small banks. They have more stress testing. They have thicker capital buffers, all kinds. They have more liquidity hoops that they have to jump through. All kinds of regulations are tighter. And this seems to me to be a sensible approach because of the too big to fail problem. So it's explicitly trying to push back against that problem. Okay. Next kind of issue, classic issue where there's lots of research is this question of what shifts bank credit supply and what are the consequences of those shifts. And sort of the literature has kind of two subcomponents. One is sort of macro-oriented, so thinking about changes in monetary policy as moving around bank credit supply. In the classic approach to this, the central bank can differentially raise the cost of funds to banks by tightening monetary policy, and that shifts credit supply down when they're tightening it up when they're loosening, and then that can have real effects on the rest of the economy. That sort of classic channel is sort of off the table today when we have trillions, I guess, of excess reserves at the central bank. And so in a recent paper in QJ 2017 by Drexler et al., they construct what they call a deposits channel of monetary policy. And what that does is it allows the central bank to shift credit supply through banks without a reserve channel. And the way it works is because banks have pricing power in deposits, when market interest rates rise, the wedge between deposit rates and market rates widens, and that leads to an outflow of funding from the banking system, and that can shift credit supply. So that's kind of a very clever way to bring back this mechanism. And it's really important to understand the impact of monetary policy on the real economy. So this is kind of like the macro way of thinking about the credit channel. The finance guys, people like most of us, are more kind of like into the micro approach. And there people will either typically will look at things like shocks to the solvency of the bank, or maybe changes in regulatory capital, and then trace out how that shifts credit supply. Big picture, the literature has basically, I think, nailed that this is important, that bank credit supply matters, that some firms have frictions and have difficulty switching from one bank to another. So if a given bank's credit supply declines, it tends to constrain investment for some of their customers, the ones that have a harder time switching. And, we've seen this result in multiple countries with different kinds of identification strategies, lots and lots and lots of research on it. So in terms of directional effects, there's sort of zero doubt that it's there. I think where, the literature probably should go now is really focusing more on magnitudes and on, which parts of the economy are more or less sensitive to these kinds of effects. But the presence of the credit channel is pretty well established. Another issue, this is near and dear to me. I put it as classic. Maybe I shouldn't do that, but I've worked a lot on it, so I call it classic. Is sort of understanding the role of branch banking, and its impact on competition and market integration. So the literature, some of these papers I've written, I think has documented looking back, and I'm going to be talking about maybe things aren't going to be like this in the future, pretty much establishes the importance of the location of bank branches, both for collecting deposits and the competitiveness of deposit markets and for credit production. So the argument there is that, where branches are matters because it affects the distance between firms and their bank, and distance is important in, making it expensive or cheap to build relationships between borrowers and bankers. It affects competition both on the deposit side and the lending side. And it's also important in integration. So the integration is the idea that, in a very backward financial system, you may have pockets of capital that are sort of trapped and have a hard time flowing to their highest return. And when you have better integration, capital can move more easily to find the highest return. And so when you have extensions of bank branch networks across multiple markets, you're basically making it easier for capital to move between markets, and that's efficiency enhancing because capital can flow toward its highest return. So some of my papers have focused on these questions and emphasized the importance of regulations which in the past had restricted the ability of banks to extend their branch networks. Spatially, though many of those were removed, basically all of them were removed gradually in the 1970s, 80s, and 90s. So punchline in this literature is branching has been very important. You could think of it as just a very important kind of friction in the financial system where the branches happen to be and who owns them. Okay, so I'm going to use that word because I'm going to argue that what's happening now is making those frictions fall very drastically. Because that could have fundamentally change a lot of these kinds of relationships. Relationships in community banking. So another big, topic in the microeconomics of banking, if you will, is what is the importance of human interaction or relationships between banks and bankers and their customers. So relationships, it's been demonstrated over the last, 30 years or so. The paper, I think that's seminal on this topic is Peterson and Rajan's JF paper. I think it's 94. So that was like the first data where people could actually measure things like how long a borrower had been at, what kinds of services they were purchasing from their bank, et cetera. The literature has sort of wrestled with measurement here. It's not obvious the best way to measure how strong a relationship is. People use things like just time or, just looking back, who was your last lender. But if you look in the data, it seems like these are really, really important. Even in the syndicated lending market, there's a really strong stickiness of banking relationships, a very strong level of persistence in who individual firms borrow from. That's even at the largest firms. It's not just small firms. Now, the issue of size here is important because, one of the arguments that's been made to argue that there's a role, sort of a long-term role for small community banks is that because of organizational complexity in large banks, small banks can do a better job of managing interpersonal relationships between their employees and the local business community than a very complex organization can. And therefore, smaller banks, particularly when you're thinking about small business lending, the argument goes, have a comparative advantage relative to large banks. And there's no doubt in the data that they do more of this, and the empirical support for that's pretty strong. And again, I'm going to emphasize in a backward looking historically. Whether or not that's going to continue is a question that is not clear to me. Okay, so that's kind of like, I think, what we think we know from the past. Now I want to sort of talk about things that are happening or have happened that potentially create challenges to that traditional model. And what that means is that a lot of these relationships that we know are potentially going to change in the future. Now, this one's not really new. It's been going on for a long time, but I'm going to argue that it's even more important now than it has been. And that's the rise of shadow banking. So what do I mean by shadow banking? I basically just mean some combination of credit and liquidity happening in structures that are not traditional depository institutions. So, one model of that is maybe a mutual fund, particularly if the mutual fund holds assets that were originated in the traditional banking system, like loans. That would be an example of a shadow bank. Or another example of this, which was at the center of the global 2008 financial crisis, is asset securitization. So that's the credit part, starts in the banking system and then moves into markets. And then that is funded by entities that finance themselves with overnight repurchase agreements. Okay, so that, Gorton and Metrick's paper Run on Repo is emphasizing that model of shadow banking as being right at the center of the global financial crisis, because the collateral value was falling and then the repo wouldn't roll over and the repo haircuts went up. And the dynamics of that are very, very similar to an old style bank run. In fact, some people, the shorthand they use to describe 2008 is a run on the shadow banking system, right? That's the way, if you push an economist to define what happened, that's the sentence that should come out of their mouth. So in terms of the research questions, though, this is critical one to think really hard about. Why is shadow banking becoming so important? I'm going to show you some data in a minute that shows this fact. Shadow banking grew really fast leading up to the global financial crisis. People were blind to the risks there. The global financial crisis happened. Okay? So we learned something, right? You would think? Actually, we didn't. We didn't learn much. What did we do? We reacted by passing legislation to add more regulations to traditional banks. And we didn't do anything to the shadow banks. To a first approximation, we did very little to the shadow banks. So the incentive to be a shadow bank in order to avoid regulation, this is the bad reason to have shadow banks, is more than it was before the global financial crisis. So if shadow banking happened because of regulatory arbitrage, avoiding the burden of the fact that we regulate banks, if that's why it happened, we're doubling down on that problem going forward. Now, that may not be the full, I'm not saying that that's the only reason by any stretch of the imagination. Financial innovation, deepening of markets, this is good, right? This adds competition, this lowers the cost of credit, expands the availability of credit, and that's very important as well. Like securitization is a big idea. It started in the mortgage space, and then it's just extended itself into different kinds of credit markets. And it's a good idea. It's a big idea that's reshaped finance. Yes, some of it might be regulatory avoidance, but most of it, I think, is probably innovation. In terms of the research challenge for you guys, I don't think we know. If you ask me what percentage of the growth of shadow banking is from regulatory avoidance and what percentage is innovation, I don't really have an answer to that question. I think that'd be a really important question to answer. Some way to quantify that. In terms of the sort of why this is so important, what is the effect on financial stability? This is really at the center of that. The 2008, that's shadow banks are right in the middle of it. In 2020, we have another financial panic, and again, it's shadow banks that are at the center of that. So this is why I think this is such an important question. We really need to understand better why this is happening and what to do about it. Like, how should we regulate them? Let me show you a little bit of data. Hopefully you'll be able to see this. This is just demonstrating that the impact, this is basically representing the decline in the lending role of banks as a percentage of total credit. And most of the decline actually happened before the global financial crisis. But the other thing that's happening is structures that hold loans that were produced inside the banking system. These things are moving more and more out of the banking system. So this is a graph from a review article that I wrote with Tom Schneider and Jun Yang, who are in the audience, that shows, basically compares the growth rate of traditional banking with shadow banks. Okay, so the top figure is ETF bond funds. Okay, so this is a structure that got hammered in 2020 in the pandemic financial crisis. So what you see, we had to put it on a separate scale because the growth rate is so explosive. We couldn't put it on the same scale as banking because you wouldn't see the banks going up at all. If you go, this is going back to early 2000s. The structure has grown by 40,000% since the beginning of the 2000s. It's big. It's around a little bit less than 1 trillion in size now. So it's still not at the same level. The banking system's number like 20 trillion. So it's not at nearly at that scale, but it's growing really, really rapidly. Another structure that's growing really quickly are mutual funds that hold bonds and loans. So that is represented in this line right here. That's growing about 2.5 times as fast as traditional banking. This is the growth down here of bank assets. So by the time you get to the end of the sample, banking is around 20 trillion, and these mutual funds are around 2 trillion. So they're not of the scale yet, but they're growing faster. The other thing to notice here is the growth rates of these shadow banking structures accelerates post-2008 crisis. So that's the irony that I was saying before. We have a run in this segment, and we regulate the other guy more. Like, that's exactly, I'm not saying we shouldn't have regulated the banks. We probably should have done that, but we should have thought harder about what to do about the shadow banks. Now, people did think about shadow banks, and they tried to make money market mutual funds more robust to a crisis. So remember, in 2008, the money market mutual funds faced a catastrophic run after Lehman Brothers went down, and then they got bailed out after, I think, 4 or 5 days of the run. The guarantee was, boom, put in place, and it stopped. Okay, so there's a lovely paper by Lee et al. This is so small. Basically, what they do in this paper is they compare the run on money market mutual funds in 2008. That one you can kind of excuse. We never seen anything like it before. It was out of the box. Oh my God, what happened? But the part that's harder to excuse is what happens in 2020. 12 years later, all kinds of work went in to try to make the money market funds robust to a run. And we have a run that is not only, it's like exactly the same as what happened in 2008. Here's the data. So the red line here is 2008 and the black line is 2020. And in both cases, the money market funds lost about 30% of their funding over the course of about 5 days. And then the bailouts kick in both cases. So that's kind of a depressing reality. We haven't figured out yet how to make these structures stable. I think what we know from this though is, if you put your money in a money market account, that thing is safe because the next time the run happens, there's going to be another bailout. I'm pretty sure of that. 2 times in a row. Yeah, it's going to happen again. Okay. So that's shadow banking. Let's see how I'm doing. I'm doing fine. Okay. So a related topic is this topic of, I know fintech is like a big word and it means a whole bunch of things. I want to kind of focus it a little bit narrowly in thinking about payment systems. So in the traditional world, before we had technology, the banks basically had a monopoly on the payment system. Okay, that's an incredibly important function, but having that monopoly, going back to that original first question, was important in these information synergies. And now we have a situation in which non-bank payments providers are really, really ascendant. So companies like PayPal and Venmo and Google Pay, Amazon, Apple, all of these companies are getting involved where people make payments through their phones. And so that means that the data, the sort of the specialness of access to that payments data, it's increasingly implausible that that resides only in banks because the tech sector is getting it first. So this suggests that the information environment can change fundamentally. And so what that means is one of those sources of glue that's sort of holding banking together isn't as strong as it used to be. So I think this is what is the impact of the rise of these sort of, phone-based payment systems, tech-based payment systems on the information synergy between deposits and credit? That seems to me is a really important research question. And, theorists should think about it, empiricists should think about it. I think there's a lot to be done there. One thing that's interesting here too, though, is that, and maybe the place to study this is somewhere else outside the U.S., economies like China or India or even the EU are ahead of the United States in the impact of these technologies. The U.S. is really kind of a slow adopter here. A related question is whether central banks should get into the digital retail payments system. So CBDCs is central bank digital currencies. That's an active debate. The European Central Bank seems to be more gung-ho to do this than the Fed. The Fed's not saying hard no, I don't think, but it seems to be dragging its feet on this topic. There's a kind of a cool paper. I have one graph from the paper. Let me skip ahead. Is it this one? Yeah. There's a cool paper by Berg and co-authors, which argues that the views of the Fed versus the ECB exist for basically political economy reasons. And the argument that they make is that the U.S. payments companies like Visa, have tremendous impact on the European payment system. So from the point of view of the Europeans, a central bank digital currency would threaten the rents of an American payments company. So it looks good to them. And from the point of view of the Fed, eroding the rents of a powerful payments company like Visa maybe looks less good. And just a little bit of fun data, they have a graph. This black line here is the relative market capitalization of payments companies in the U.S. to traditional banks. So by the time you get to the end, the payments companies are around 2/3 the market cap of all U.S. commercial banks, and it's risen a lot. In Europe, it's still dinky. So, I mean, that's kind of an interesting explanation for the different views of the two central banks. How that will play out, I'm not sure, but I think it's something to keep our eye on. So the impact of these technologies, like it's potentially, if it shifts the environment enough, that could be an existentially, threatening event for traditional banking, because that glue isn't going to be as adhesive as it used to be. The issue of financial stability is also really, really key here. When the Silicon Valley Bank went down, it ran out of that bank super, super, super fast, because now you just push a button on your computer and you can send your money to a new bank or to Fidelity or whatever. I think for the first time ever, the FDIC's playbook is get to the weekend and then shut the bank down. And with Silicon Valley Bank, they couldn't get to the weekend because the money was going out so fast. They had to close the bank in the middle of the working day on Friday, which as far as I know, they've never done that before. So that raises a question of financial stability. Another little bit of data. People probably seen this. There's this very cool paper by Tony Cookson and co-authors looking at Twitter and tweeting activity around the SVB bank run. And, they show this massive spike in search or tweets with the words Silicon Valley or SVB in it. It's interesting because, even, Manju, Puri, and co-authors have bank run analyses like micro studies where they argue that social networks are important in understanding who runs. But now we have a situation where a social network is connected on the internet. So, one person gets nervous in the network and then starts telling their friends. Very quickly, bad news can propagate through the social network, and that can make the bank a lot more unstable than maybe it otherwise would have been without it. So lots of issues to think about in the rise of these new technologies. Okay. Now, I didn't say anything about Bitcoin or cryptocurrency. If people want to talk about that in the Q&A, you can. One reason I'm not saying anything about it is because I just don't feel like I can say anything intelligent about it. I don't really know enough to opine on that, but we can talk about that if you want at the end. Okay. What about community banking? And what about bank branches? So, one of the facts that's been going on at an increasing rate in the U.S. is the decline of bank branches. Okay, so let me show you a couple of pieces of data. So this is a graph of two aggregate series. One is the number of banks in the U.S. going back to 1934. That's the blue line. And then the second one is the number of offices and branches in the U.S. banking system going back to 1934. So what you can see is the number of banks starts to go down around the early 80s. A lot of that is due to the impact of regulatory change that allowed large banks to buy into new markets by purchasing smaller banks and extending their branch networks. But that process didn't extinguish the aggregate number of branches. You can see that the number of branches keeps marching up until you get to about 2010, and then things start to turn south. Okay? Now, over here, it's hard to see in this graph, but the decline is accelerating. 2020 was really remarkable. We lost 5% of branches in 1 year in 2020. I'm sure the pandemic was something to say about why that was so big. But even 22 and 23, I think 22 we lost about 2% more, and then 23 another 2 or 3%. So the number of branches is definitely falling in the U.S. You still read articles in the newspaper about so-and-so bank adding branches. Okay, yeah, but the total is definitely falling. If we compare the U.S. to Europe, that's the next graph. I find this picture fascinating and compelling. So what it is it's a measure of branch density. It's the number of branches per 100,000 people. So what you see there is just before the financial crisis, the European banking system and the U.S. banking system had a similar number or similar density of bank branches per person. Then the numbers start to decline in both places, but it's falling about twice as fast in Europe as it is in the U.S. Okay? Why? Well, my conjecture is probably because the advent of these alternative tech-based payments mechanisms is ahead in Europe relative to the U.S. I mean, the Europeans have better cell phone coverage. Just the most simple infrastructure is better there than it is in the U.S. So, in Europe, the number of branches has dropped by 50% in the last 10 years. That's really, really, really stark, having risen for the prior 100 years. So something big is changing. And the fact that the U.S. is way behind, this tells me, my expectation is we're going to end up down here. It's just taking us a little bit longer, or maybe it'll continue to decline. Why is this happening? Well, if you have an information environment where everything is intermediated through technology, distance to a particular branch, does it matter at all? And if you think about an extreme situation of a cashless economy and information all being intermediated through tech, it's hard to see why we need branches at all. I mean, as long as you have cash, small businesses got to have some place to put the cash. So you've got to have some kind of structure there to protect it. That's what we call a branch. But if you get rid of that, it's hard to see, what is the role of branches? And then let me go back to this slide. The implications of that change are probably biggest for the small banks, because it's the small banks that have traditionally relied on local presence and interacting on a human level with the business community, and all of that works because you have a branch presence. So it raises the question, what's the future, or even to put it really starkly, is there a future for community banking in the face of all of this new technology? I'm not sure, but let's take a look at this. This is a graph of the profitability of banks of different sizes. So the top panel is return on assets. The bottom panel is return on equity, okay? Stratified by size. The orange are the biggest banks. And you can see, particularly when you look at return on equity, they have consistently been more profitable than small banks. The only exception is during the global financial crisis. Consistently more profitable at the same time as the number of small banks is consistently falling. Okay? So, if you just extrapolate that out, it doesn't take a big leap to think maybe, there isn't a very good future for community banks. This message does not go down well with the regulators. I was on a panel. I presented this back in early 2000s, and I observed exactly what I just said, because it was true then too. The number of small banks was going down, and I looked at pointed at the profit figures. They said they're less profitable year after year after year. It's not surprising that the big banks are buying them up. And after the session ended, a very senior Fed official, governor, gets me aside, says, "Oh, you're completely wrong about community banking. It's not, and he starts doing the dance about how great, the roots in the community, all of that stuff. I said, okay, maybe you're right, but what about that? He didn't really have a good explanation for this. So, and it's continued. I mean, my opinion on that interaction, which I remember, it was a long time ago, but I remembered it because this person was a high-level guy. I think I was right. I think that the facts are on my side. But I don't know what's coming. Maybe the community banks will stick around forever. I don't know, just at a low. So I wanted to say a little bit about deposits and the deposit franchise. So this is another, what I think of as very important current issue in banking. So the question is, how valuable is the deposit franchise, and how stable is that value going forward? Okay, it's the second question that's hard to address, and where you get speculative. The deposit franchise value, what is it? It's the value that's created at banks because they are able to price their deposits at interest rates that are below market. Okay, so to the extent that there's a wedge between the market rate of interest and what banks pay for deposits, that's a source of profit for them. And there's a nice recent paper by Drexler, Savoff, and Schnabel, where they basically break down the capitalized value of the deposit franchise into some very sort of simple parameters that help us think about the problem. So it basically breaks down into, DF stands for deposit franchise. How many deposits does the bank or banking system, you could think about it in an aggregate sense too, have, multiplied by 1 minus W. So 1 minus W is the fraction of those deposits that are going to stick in the bank. So that W parameter is really important. If W is 1, That's like a bank run where the deposits go away completely and the franchise value goes immediately to zero. That quantity gets multiplied by the 1 minus beta term. So that represents how advantageous it is to have deposits relative to market rates. When beta is 0, it means, you don't have to pay interest at all. If beta is a half, it says you pay half of the market rate of interest on deposits. So the average beta right now is a number like 0.4, something like that. And then that C term is less interesting. That's just the cost of managing the branch network or whatever network you need to collect the deposits. But the nice thing about this is it focuses ideas, and the two things that are critical are sort of stickiness, what's the tendency of banks to stay where they are, deposits to stay where they are, and then the beta is the pricing power of the banker. Okay, so my view of the world is, with technology being what it is, with it becoming so easy to move money around, that should put a lot of pressure on banks to price their deposits closer to market than they used to, because customers can move their money to another bank that's paying more, or they can move their money out of the banking system into money markets or into some other investment that they want to. And all of that ease of moving money, it's a lowering of switching costs, if you will, that should reduce the degree of market power and the ability to price deposits below market. But when I look at the data, I start scratching my head, because the value of the deposit franchise seems to be continuing to be there. Okay, so let me show you what I'm talking about. This is just a graph of the overall deposits in the U.S. banking system going back 20 years. So you sort of have this increase in deposits during the zero lower bound QE regime. Deposits were growing rapidly, more rapidly than the economy during this period. And then you get an explosion of deposits because of the pandemic programs. And then you have the tightening of monetary policy. So you see the data starts to turn at the end. Let me zoom in on that. Okay, here's zooming in on the last few years. When the Fed pivots to tightening interest rates in the beginning of 2023, end of 2022, deposits start to move out of the banking system. That's because some depositors are rate sensitive. Okay, we know that that's where the deposit channel of monetary policy comes from. Then you have SVB, and you get this big jump down. Big, I put in scare quotes, because it was big enough to scare the FDIC and the Fed to basically commit to backing all the uninsured deposits in the banking system. What no one has said is, what is the time limit on that? I don't know what that is. Is it still there or not? No legislation has passed, as far as I know, changing the law. So that's an interesting question. But then the thing that also is interesting is that in the last 3 or 4 or 5 quarters, the deposits have been staying in the banking system. This is where I think it's surprising, particularly given the pricing behavior. So let me show you the pricing. Okay, this is just comparing the Fed funds rate. This is in the most recent interest rate cycle with the weighted average interest costs on deposits. This comes from the call report. Okay, so what you see is the wedge widens when the Fed funds rate rises. The thing that surprises me is the wedge gets to be about 300 basis points in mid-2023 and stays there. I mean, I expected banks to have to start paying more to keep their deposits in it. It hasn't happened. So this is really crucial to the health of our banking system. Let me just show you that one. I'm going to skip ahead here. I'm going to skip these. We're out of time. Yeah, here. So this picture is a representation of the distribution of the capital asset ratio of the U.S. banks. The pink histogram is before the interest rates increased, and the black is what the capital asset ratio would be if you mark to market all of the assets. So they all marked down because interest rates went up so much, and you don't count the deposit franchise at all. You just pretend that that's not there. What you see is, this is data from a paper by Zhang et al. This was the paper that they produced the first draft after SVB in like 3 days. It was incredible. I don't know how they did it, but they basically did some analysis like this in just a couple of days. But what you see is many hundreds of U.S. banks are basically economically insolvent at market valuation if we don't value the deposit franchise. So from a regulatory point of view, I would argue you shouldn't value the deposit franchise for 2 reasons. One, it's not reliable. I mean, it can go away overnight. We learned that with SVB. It could literally go to 0 overnight. The second reason is all of these changes that I've been talking about of technology and mobile payments and ease of moving money, that should put increasing, and the forces are getting stronger every day, increasing pressure on banks to compete harder to keep the deposits in the bank. And that's going to drive that beta coefficient closer to 1. And that erodes the value of the deposit franchise. So it's not responsible to run a regulatory regime that's living and dying off value that's built into the fact that banks have pricing power in deposits. Because I just don't think we shouldn't have confidence that that's going to continue forever. Okay. Okay. Yeah, I have a few other, I don't think I'm going to go through these. So just one more kind of slide on issues of the day, policy, 3 kind of dimensions that I think are really important and interesting. One is just, and this is really, I guess, a macro question. Maybe it's not super relevant for this audience, but the transmission of monetary policy to the real economy, how potent or impotent is it because of some of these changes? So, the change in the structure of the banking system, shadow banks becoming more important, does that affect, or to what extent does that affect monetary policy transmission? And second, with this deposits channel, is that channel changing or getting weaker because of the role of technology and making money more mobile and easier to move in and out of banks? So I think that's one layer. Another layer is quantitative easing and quantitative tightening. And what are the impacts of that? So there's the monetary policy macro component there, but then there's also the banking financial stability component. There's an interesting argument that there's a couple of papers, working papers by Viral Acharya and Raghu Rajan, that basically argue that QE is part of the problem that was manifest with SVB. So basically what they argue is quantitative easing is the Fed buys bonds from the private sector, right? That's what they do. But if they buy those bonds from non-banks, then the bond first has to get intermediated through a private sector bank before it gets to the Fed's balance sheet. And what that means for private banks is when the Fed buys a bond, it's going to increase the private bank's balance sheet. It's going to increase its assets by the increase in reserves, but it's also going to increase its deposits by the same amount, so the balance sheet balances. And most of those or a lot of those deposits are uninsured deposits, large deposits, because they're buying bonds from, big like pension funds or something, large scale deposits that come into the banking system. And then they're arguing it's worse than that because the reversing the process of quantitative tightening, don't push me on the details. I don't think I can do it. But basically they're arguing that it's not symmetrical, so that the deposits aren't going to drain out of the banking system when they reverse the QT. So you end up with a sort of a banking system that's sort of is too heavy in deposits. If you look at the period before the pandemic, you saw deposits running up much, much faster than GDP. So something is going on there. Part of it could be the zero lower bound and the compression of spreads, but some of it could be also just mechanically because of QT. So this is a core issue for anyone studying banking. And then the last piece is, what are we going to do about regulation? So going back to my screed about shadow banks and how the Dodd-Frank Act, kind of put too much burden, relative burden on the traditional banks and not enough on the shadow banks, figuring out how to adjust regulation to shadow banking. And, maybe the biggest, most difficult problem is doing something to alleviate regulatory arbitrage. Those are really, really important questions. Too hard for me, but maybe some of you guys can solve them. Okay, so just to recap, I just identified 5 issues that I think are people should work on. Shadow banking, more papers on shadow banking, more work on fintech. And for me, the most interesting thing is its impact on payments and how that feeds back potentially into information synergies in banking. Understanding the drivers and the consequences of the decline of branching and how that might affect community banking, I think is a very important question. Understanding the deposit franchise. Is it stable? How vulnerable is it to competition? How vulnerable is it to runs and so on? Really, really important question. And then thinking hard about the monetary policy and regulatory policy implications of a lot of those changes is the 5th thing that I identified. So with that, I'm going to conclude. The one observation I'll make, and then I'll let you guys talk, is a lot of these changes. I mean, this really comes clear when you look at the deposit franchise. It seems like theoretically something big should be changing, and then you look at the data and you're like, why are those deposits not moving out of banks? Why is the pricing so sticky? And it's hard for me to justify. It doesn't feel rational. One thing I can say, though, is I remember when I worked at the New York Fed in the early 90s, everybody was saying, checks are going away. Paper checks are going to go away. And then the Fed people in payments would say, checks went up 10% last year. And we'd say, but they're going to have to go away. No, they went up 9% last, and that happened for a year, 10 years. But you know what? They did go away. It just took a while. Now it's pretty rare to write a paper check. So I think we might be in a situation like that where people like me are going to be predicting big changes. It's not going to happen. It's not going to happen. And then maybe all of a sudden things will change very, very rapidly. But only the future will answer those questions. So I guess at this point I'll stop.